All right, let's go ahead and get started. Good morning and welcome to Maynard Costerrison's 2025 GASB Update Webinar. We're so glad that you're here. Today, we will be sharing important GASB updates for schools and how these changes affect your school's financial planning and reporting strategies. Thank you for joining us today. A few housekeeping items. This session is being recorded and everyone is muted. If you have any questions, please type them in the chat and we will have time at the end to answer those questions. With that out of the way, I would like to welcome Jeff Straus, Kasey Roth, and Bill Tucker to today's session. Jeff is a principal in the audit department and a member of the firm's board of directors. He specializes in providing audit services to Maynard's education and nonprofit clients. Kasey is a senior manager in the audit department and works closely with the firm's telecommunications, education, and nonprofit clients. And Bill is also a principal in the audit department and a member of the firm's board of directors. He specializes in government and nonprofit clients. Thank you all for taking the time to share your knowledge today. And Jeff, I will go ahead and turn it over to you.
Perfect. Sorry for that technical difficulty right there. Yeah, as Cheyenne mentioned, Kasey and I were the individuals initially intended to go through this webinar and give you an overall update on the pretty significant changes that we're going to see on the financial statements with the implementation of GASB 101. And kind of going through this process, we had chatted with Bill Tucker and he had some availability to sit in on this webinar with us. He's done a lot of the legwork and prepared many of the examples that we as a firm are using internally. So having him as a special guest is going to be a really beneficial addition to our overall presentation. Going through the agenda, can you switch slides, Bill? You can see our main priority is going to be to go over GASB 101. It's going to have not only changes to the overall liability that we're looking at on the full accrual side of things, it's also going to likely impact for most of our clients a prior period restatement. So having a good understanding of how this calculation is going to be done, and then also what that impact is going to be on the financial statements is going to be very crucial very early on in the audit process. So as we start May, we have a lot of our staff that are going out for preliminary field work. And if you're not having the in-charges or anyone within the audit team asking you about GASB 101 or what you as a client needs to be doing to help prep for this change this year, make sure that it's being brought up so that we are doing really the heavy lifting between now and final field work to really identify what that new calculated compensated absence number is going to be. Then moving on past GASB 101, we are going to have a quick update on GASB 102. That will have a few changes, but overall, not a significant, mostly just a footnote reporting issue regarding GASB 102. And then if we have time at the end, we will be going through upcoming pronouncements, primarily GASB 103, and having a little bit of an opportunity there for questions that may arise. But as always, feel free to post into the chat and we'll try to answer questions as we go throughout this presentation. So Kasey's now going to kick us off on the start of GASB 101, and then I'll take over a little bit later, and Bill is going to help us understand a handful of examples when it comes to how to calculate GASB 101 and your new compensated absences liability. Thank you.
Thanks, Jeff. So GASB 101, we've been talking about it for a few years now, and it's finally here. So this statement is effective for fiscal year ends beginning on or after December 15th, 2023. So essentially it is effective for all year ends now. So it started with December 31st, 2024, continues on to the June 30th, 2025, and September 30th, 2025 year ends. And what it does is it does supersede GASB 16. might have to switch a bill. It's being weird. So why is there a new GASB standard? So as I mentioned, it does supersede GASB 16. In our opinion, GASB 16 was kind of nice. What it did is it pretty much recorded a liability for cash paid out the door. GASB 101, as we go over this in the next hour or so, you're going to realize that that's a little bit differently. So why did they do that? They felt like there was an issue of comparability between governments. That statement is kind of contradictory, as you may see coming forward, because there are going to be two flow assumptions for GASB 101, opposed to just one way of recording for GASB 16. So that could make things a little blurry, but they do believe the new model will result in governments recognizing a liability that's more appropriately shows that compensated absence amount. So when you're looking at the difference between GASB 16 and 101, the main thing that you're going to notice is that GASB 16 is really a rules-based approach. A lot more black and white, a lot easier to understand for us accountants out there. GASB 101 is going to be based on a conceptual framework, meaning that there are going to be some assumptions to come up with GASB 101. It's not going to be quite as easy. There's going to be a little bit of legwork, and that's going to take us a little bit of time to get our hands wrapped around. GASB 16 is, you recognize that liability when it's earned. In 101, there are different ways that the liability can be recognized. As I previously mentioned, there's going to be two important flow assumptions, which we're going to talk about in a bit, so it can be recorded differently. They also did change the language in 101 to say more likely than not, rather than probable, which was in GASB 16. We have a slide to explain that as well. And then lastly, there are a little bit of note disclosures, which Jeff will cover here in a bit.
Kasey, I think a couple things that, obviously we want to focus on between these two different statements. With GASB 16, I think the one area that we really want to be looking at is that difference between probable and then the more likely than not scenarios, and what those percentages kind of mean between GASB 16 and 101. So I think when we kind of look back to GASB 16 under probable, that was probably more like a 80% threshold that we were really thinking about. And then the more likely than not is more like 50%, that's going to be happening. So that's one big factor there. The other things with GASB 16 that we'll get into a little bit later is kind of those, kind of we were thinking about that termination payment method, right? So as somebody terminates employment, what is that payout that they're going to be getting compared to under 101? Potentially some of that's going to be coming through on, just their normal, salaries as they're taking that time off. So we're going to see some differences there, and things that we need to be considering as we kind of go through these different estimates. So different things to pay attention to as we kind of go through this training today. Thank you.
So this statement 101, I know we've mentioned it before, but really just focuses on compensated absences. Those are things such as vacation, PTO, sick time, holidays. We have a more extensive list here in a bit, but what it is going to do is provide a more robust estimate of compensated absences. And I did want to heavily stress more robust. You're going to notice that there is going to be a lot of legwork here to figure out what that compensated absences amount is going to be. What the new standard does is it really focuses on the past to come up with future estimates. I've seen anywhere from, in the webinars I've listened to, it's mentioning 3 to 5 years of a look back to come up with an appropriate estimate moving forward. So you're going to have to do some legwork to come up with the estimates and assumptions that you do give your auditors, which is a little bit different than what we have seen in the past. So as we're going through this, we're going to focus on a few main areas for the standard. We're going to go through recognition, measurement, those flow assumptions that we've already spoke several times on, and then the financial statement and presentation. So under GASB 101, a compensated absence is leave for which an employee may receive one or more of the following: So cash payments when leave is used for time off. So, right, traditional PTO, you get paid when you take leave. Other cash payments, such as payments for unused leave upon termination. So those are those clauses in contracts where you potentially get $100 to $500 a day for that remaining PTO. And then you have that non-cash settlement piece, such as conversion to defined post-employment benefits. Compensated absences do not generally have a set payment schedule. And then, as mentioned before, those examples of compensated absences are vacation, leave, sick, paid time off, there's sabbatical, bereavement, etc. One thing I do want to stress is just because it's a compensated absence does not mean that it would be accrued at year end on your financial statements, right? So for it to be accrued on your financial statements and a liability, it would have to be for earned through past service. So that's going to be this top category you're seeing right here. So past service you earned on vacation, sick time, and PTO. That's traditionally and still will be what is going to be accrued as compensated absences on your financial statements on that government-wide statement. You do have a small amount of compensated absence here listed in that middle section. That would be sabbatical leave, jury duty, parental leave, military and bereavement. That is stuff that's typically not triggered by service already incurred, but could potentially be accrued if it happened right at year end or crossed fiscal period. So pretty rare that would be included, but it could happen, if you had maternity or, some sort of military leave, cross through fiscal years. And then eligibility that's not based on past or prior services, really not going to be accrued, is going to be your holidays or unlimited leave, if anybody does have that.
I know one of the questions that we've received related to specifically that middle section there related to parental leave is those employees potentially that are taking, parental or a maternity leave, right at fiscal year end. So obviously you're recognizing a liability, say somebody have a June 30th fiscal year end, somebody goes out on maternity leave at June 20th. Okay, well, they might be off for 12 weeks. So you're going to, recognize that liability for that period of time. Well, if say, obviously you're getting your audit done in August or September, we know somebody went out on maternity leave July 10th. So after the fiscal year end was over, that would not be recognized as a liability at that specific date of June 30th. So there's a little bit of difference there, specifically on that timing of when that employee, when that commences. And that really is the triggering factor for recognizing that liability.
So this next slide is really a little bit of a graphic of what we just spoke on. So some exclusions are going to be conversion to defined benefit and post-employment benefits, leave without specific terms, and then holiday leave. We do list the sporadic events as exclusions, but as me and Bill just spoke on, there are points in time where there could be a little bit accrued, but nothing expected to be significant there. So we've gone a little bit into the rules back and forth of GASB 16 and 101. So what exactly are the rules now for 101? Well, liability should be recognized for leave that has not been used if all of the following are true. That leave is attributed to services already rendered, right? That's true definition of a liability there. The leave accumulates, and the leave is more likely than not. That's that 50% rule, and we will go over that a little bit more extensively, to be used for time off or otherwise paid in cash or settled through cash means. That last bullet point really is the difference maker here in 101, right? For GASB 16, we really recognized cash paid out. Now we need to assess, more likely than not, if that time will be used as well. So once we get to this next slide, we'll kind of go over that. So this more likely than not is this 50% rule. When I was initially reading through the standard, and you have to assess, is it more likely than not that people are going to use, PTO or sick? I think in my head initially, I thought, of course, you would use your PTO and sick. What are you really assessing here? What really comes into play here, especially as sick time, is if you can only use sick time for when you're sick, and you already have, let's say, a 300-hour balance, what's the likelihood that you're going to use that, right? And how do you assess that? So a government, they have to evaluate whether the leave is more likely or not to be used. And there are certain factors that are going to come into play. First, the government's employment policy related to the compensated absence. So, how much are you accruing each year? Is there a cap, etc.? Whether the leave has been earned or will become eligible for payment in the future. So sick time, let's say, is it just you need to use it, or could you get paid out at the end of a year, or, at retirement? Historical information about the use and payment or forfeiture of compensated absences. This is probably the most important one, and that's where I mentioned previously that you need to use historical data to come up with future assumptions. So as I was speaking on the sick time, you may need to do some assessment to say, you're getting 40 hours of sick time a year, but you're normally only using up to 30. How are we going to record that compensated absence? At that point, is it more likely than not that you're going to use every year of sick plus your prior year bank? And that these are some of the questions, and you'll see as we go through the examples that do come up. And it's not quite as black and white as GASB 16. It does require a little bit of thinking and using these flow assumptions and thoughts. So information known to the government would indicate the historical information, and that's where I mentioned kind of that look back. So you recognize a liability for accrued leave, as I mentioned, for services already rendered, when it accumulates, and whether it is more likely than not to be paid or used out. The relevant factors, once again, are employment policies, future payments, and historical information. So we're going to really encourage everybody to look at your employee handbook, and then use some historical information to figure out our assumptions going forward. As I mentioned, I know that doesn't sound fun. It is a little bit more of a robust process. That is why this change is so big and time consuming for not only the auditors, but the government entities. You're good. So the measurement basis is where I believe I am passing it over to Jeff.
Yep. All right. Thank you, Kasey. So as we can already tell, there's a lot more going into this than maybe what we were looking at when it was just under GASB 16. And since we know that for all of our school districts, we are going to have a long-term obligation under the compensated absences standard. So under GASB 101, we've done that through the recognition standpoint. We know that it's out there. We know that now we have to calculate how that looks differently from what it maybe looked like in previous years, which is ultimately probably going to also end up in a restatement of that prior year information as well. But how are we going to go about measuring what this liability needs to be? So by and large, we are going to be looking at what those employee pay rates were at the end of your fiscal year. So that's going to be the main point of how we're measuring the compensated absences from an hour standpoint that we are ending up with. Now, there is going to be some other items that play into this on whether or not we're using LIFO or FIFO, which I will talk about those flow assumptions as well. Maybe we're going to end up saying on the LIFO side of things that most of this is going to be paid out at a reduced rate, say 50% of that employee's pay rate upon termination or upon retirement. And then we're going to see maybe a reduced liability under LIFO versus where we would probably end up under FIFO. When we're talking about this cash paid or non-cash settlement, you can really think of this piece as where we end up on our just accrued payroll side of things. So they do factor that within this standard. But when we say cash paid, this is really looking at those balances that were used prior to year end, but just hadn't been paid out. When we're talking about the employee pay rate side of things, these are liabilities that really hadn't been used at year end. And now we're trying to come up with what that balance is going to be on the overall compensated absences liability at year end. Factors to consider. Kasey mentioned this a lot, but it really should be reiterated in quite a bit of, I guess, exaggeration, if I will. We are going to look at employee policies. So if you have an HR policy that is talking about what the accrued rates are going to be for all of your various levels of employees. So for schools, we're going to be looking at different union contracts. I recommend you go through and look at each one of those union contracts individually and then come up with a cumulative total after you add them all together at the end, because I really just don't know how you're going to come up with a lot of these assumptions based on all of the variations that might be in some of these union agreements. Future considerations, this is where we're starting to look at maybe what's going to happen, or have some of these days already been taken, and now do we have to factor that back into our calculation? What is that future payout if we're going to factor it in as part of a maybe reduced pay rate, like I'd already mentioned on the retirement side of things? Maybe you are paying out at 50%. But where the real challenge of this standard is going to come is, how do we come up with our hours that we're even trying to measure? And this is where the historical information comes into play. So you might want to start looking into your software today to see what information you can get out of it, how granular you can get that information. Can you pull it out by union agreement or by employee type to really come up with what has happened in the past? How often are individuals using all of their sick pay? This is where we're really trying to pull this information together to come up with an overall hour standpoint that we can then add a pay rate or some sort of measure to it to come up with that overall balance. And as we've mentioned all along, when it comes to this overall liability, we're not just looking at it from what would be the payroll side being paid out. We're also trying to factor in that FICA that would be related to it, and likely the defined contribution, especially if you're using FIFO when you're paying out at that current employee rate, rather than assuming that we're going to be paying that out at retirement. And a lot of this will become more clear as we work through our examples a little bit later on. So this is kind of the big point that we've mentioned. I guess we've kind of danced around the topic a little bit, but it's this flow assumption methodology of whether or not we're looking at it from an overall FIFO or LIFO standpoint. For a lot of us that maybe remember our college class days, maybe we're not using FIFO and LIFO on the inventory side of things all that often, but we do know that it kind of is out there. We just haven't seen it as much on the governmental side of things, or really had to consider it in the same way that we're going to be thinking about it when it comes to this compensated absences or GASB 101 calculation. This next slide will give you a little bit more information on what we're talking here. So when we're looking at the overall accrued days or accrued hour balances, the LIFO or FIFO methodology really comes in when an individual uses their hours up. Are they taking those hours away from the first hours that they earned, or are they taking it from the last hours? So in the LIFO, you can see they're going to end up taking in those very last hours that have come in, so the ones they're earning most recent, and using them as part of our calculation and part of our assumptions. On the FIFO side of things, they're saying, well, what were those oldest, or the ones we earned first? And we're going to say that that employee is now using those very oldest hours or days that they accrued whenever they take time off. So it does change the methodology of how we're coming up with both our calculation and then also how we're measuring this balance when we actually do our calculation at the end of the day. It is important to note, though, as far as within the standard, there's no mandated use, whether it's FIFO or LIFO. I think GASB, from an overall standard setter side of things, believes FIFO is going to be the methodology that's used more often, but just in practice and in talking to clients and talking to other CPA firms and individuals within our firm, it's really going to depend on each individual client or organization on how this methodology is being determined. I don't know if I go ahead.
Yeah, I mean, it was interesting as you kind of read through like the GASB statements, and specifically GASB 101. If you kind of went back to kind of the due process that the GASB goes through, they go through some different processes to kind of before they issue a final statement. So in their exposure draft, they actually were talking about They thought that every government used FIFO, and they were kind of leaning that way, saying, okay, everybody's going to use FIFO. It'll be, pretty consistent across the board for all municipalities then. I think through their process there, they did get some comments back from different organizations saying, well, it's maybe in our policy that we use LIFO. They thought it might be a significant change to change from that FIFO to LIFO concept. So that really is something that was a big change from the exposure draft to the final issuance, where in the final issuance they're saying, well, they're just kind of silent on it, of which method people should be using. I think it does, impact the consistency within the financial statement, so across government. So if one government's going to be using FIFO, they might see what they currently have for compensated absences, go up 3, 4, 5 times from what it was previously. If they use the LIFO concept, maybe it's, it is an increase, but just a slight increase from where it was previously. So again, you're going to see that big variations between where each municipality's at or school district's at on those, the flow assumptions, but also that liability that would be reported on your government-wide financial statement. So again, that consistency piece is just kind of lost because of them not saying specifically we need to use a certain assumption there.
So this next slide gives you a little bit of a comparison here between the two. And there are similarities, but there are some pretty significant deficiencies. We already talked about the difference between FIFO, like the core difference between FIFO and LIFO, as far as when you're taking those days away from your accrued balance. We talk about the FIFO methodology being the more aggressive liability, and most of that has to do with how are we measuring the balance? Because even if you have the exact same overall hours accrued under FIFO and LIFO, when you're talking about which hours you're trying to measure or value, it's going to be typically a lot higher at the FIFO methodology, as Bill had mentioned. And that's mostly because you're saying we're going to be using all of these hours at our current rate. I mean, we're not using these hours that we've already accrued and then likely paying them out during retirement at maybe a reduced rate. So we're using what we already have in our bank, and those are going to be used at, say, a 250 or 300 hour employee rate. Then when you're looking at the overall LIFO methodology, you're saying because we're using all of the hours that we're going to be accruing in future years, those are what are going to be used up at our current pay rate. And anything, as long as we're earning more than we're using year over year, what we already have banked is likely going to be paid out at retirement. Now, these are all part of the assumptions that we're making when we're coming up with this calculation, but that's why you're largely going to see a higher FIFO calculated balance than what you would see under the LIFO methodology. So just something to keep in the back of your mind as we work through all of this. Your question now might be, well, how are we going to determine all of this? I mean, there may be organizations out there that have an HR policy that says you're always using your oldest hours first. I highly doubt that's going to be the case. Maybe you're going to be seeing a situation where labor agreements talk about the same information as well, and it's pretty clear. But probably the reality here is you're going to need to sit down from a CPA client standpoint or with your auditors and really determine what you think or how you maybe have been using up these hours in the past and try to reflect that into your current methodology. Maybe you end up just saying, we don't know. I mean, our software doesn't give us enough information on how this is actually being tracked and which hours are being used when someone takes PTO. We're just going to go with the FIFO methodology. I know it's a more aggressive, probably a larger balance, but that just seems easier and makes more sense to me. If you talk to your auditor, I'm sure everyone can come to an agreement that that may be a perfectly fine methodology to go with and just move forward. I think the big piece on this is you're really not supposed to be changing your policy year over year. So if you go with the methodology and it ends up being FIFO, you're more or less locked into that methodology, and it's probably what you want to be using going into your future years. A lot of what's on this slide has been discussed already, but this is just all of the items that, as you're working through this year's calculation, that you really want to be pulling together and taking into consideration. So obviously we want to look at our policy review. Maybe we do want to make a modification of our HR policy to say we use a specific methodology like FIFO or LIFO. We want to look at our union agreements or anything else that might come into play. We are going to need to pull payroll information and reports to see how likely are some of these amounts being used across the various union sections, and make sure that we're making very, I would say, formal assumptions, even if they are estimates, on how we're coming up with our overall accrued hours or day balance. Recognition, we talked about a lot of that. We've determined which areas from whether it's sick leave, PTO, which types of compensated absences are going to be included. And then all of this flows into how we're going to measure that overall liability. So a lot of this we've talked about, but the big thing is that very last point. Make sure you are having those conversations very early on with either the in-charges on your engagements or reaching directly out to the partners to make sure that you're on the same page and nothing is getting dropped between now and final field work, and everyone's on the same page, and we have a good plan to how to come up with this new calculation for compensated absences. I think I'll be handing over to Bill now for a couple of examples.
All right, well, thanks, Jeff. So I think the thing we want to kind of walk through here is we want to look at a couple different flow assumptions with that LIFO, FIFO. So really trying to drill down into both of those concepts that we've been talking about. It's probably the first starting spot that you really want to start thinking about as you're implementing GASB 101 is, which method, are we using? Are we using that FIFO or LIFO? And that definitely makes an impact on some of the other assumptions that you're be going through and estimates, as you kind of go through and make a determination on those balances. I think the one thing that we did find out as we went through and have done some of these as, for some of our government municipalities that implemented at December 31st, or even some examples with other school districts is, obviously there's a lot of different assumptions, and probably there's some different assumptions based on the different groups of employees. So some of those different, groups of employees would be like specifically for schools would be maybe teachers and those teacher contracts. Maybe it's support staff, maybe it's administrators. So again, thinking about each of those in different, buckets and what those assumptions are going to be for each of those different areas. So let's look at this example for our flow assumption. I do have some different assumptions at the very top of the page for this one scenario that we'll have for both of these FIFO and LIFO examples. So this is what we have. So employee A is paid $40 per hour, and we're assuming that employee A has 5 years until retirement. The other assumption is, or thing that we know is upon termination of retirement, they are paid at 50% of their PTO balance. Now, I think, and as we go through this example, it's probably easier to start at the bottom one, bottom example under the LIFO concept. And I think as we kind of go work through that LIFO concept, the FIFO concept will definitely make more sense as we kind of go through and talk about that. So and we have exactly the same scenario for both of these, and you'll see, the difference just in the liability for the one employee. So if we look at the bottom example, for LIFO example, we have PTO hours at June 30th of 100 hours that is remaining. As we look at the historical data for what those employees have earned and what they have used over a period of time, so again, typically 3 to 5 years worth of data there to come up with some estimates. We have looked back and said, okay, this group of employees or this specific employee has earned approximately 50 hours per year, and they've used 40 hours per year. So as we kind of work through our example, so we're looking at the bottom chart there, at the end of year one, that PTO balance that they have, the last in, first out, or the balance that they have at June 30th, 2025, is still going to be remaining there after year one. So after year one, they say, okay, well, we had 100 hours, we earned another 50 hours, we immediately used 40 of those hours that we just earned. So we still have that 100 hours remaining. As we kind of walk through that scenario for each of the 5 years, we can see that that 100 hours would remain all the way till they get to retirement. We would look at it, say, okay, at retirement, that 100 hours we would pay out. We pay that $100 or 100 hours at $40 per hour, so $4,000. And we know upon retirement or termination, they are paid at 50% of their PTO balance. So in that situation, our LIFO liability would be $2,000 at June 30th. So again, we're looking back at our history, saying, here's some of the assumptions that we're using. How would that play out over that next 5 years to when they get to retirement? So are they going to be using it as salary, or is it going to be paid out at retirement? And in the LIFO example, they'd be paid out at retirement. Now, what we're going to see on the FIFO example is they're actually going to be paid those hours, during their employment. So they're going to be paid as part of their salary, the compensated absences, or when they're taking that time off. So if we look at that top example, same exact situation, we have 100 hours at June 30th. We're going to earn 50 hours and use 40 hours per year. So as we kind of look at this over the next couple of years, in about 2.5 years, they're going to be using up their entire 100 hours balance. So you can see after year one, they're going to have about 60 hours of that 100 left because they used 40 of it in that year. The following year, they're going to use another 40 of that 100 hours. So they're getting it down to 20 hours. And then after year 3, they've used all that 100-hour balance. So again, under that concept, they're going to be using all of that or earning all that as part of their current salary. So we would take it, the liability times their $40 per hour, and we would say that their FIFO liability is $4,000. Now, a couple different things that we want to talk about in each of those different liabilities. I know Jeff mentioned this already. So if we're thinking FIFO, they're getting paid out as part of their salary. We're going to also factor into that the FICA, so 7.65%. And we're also going to factor in the defined contribution pieces as well. So any defined contribution percentage would also be factored into those payments for if it's paid out in salary. If we look at that bottom liability there, the $2,000, we would just include the FICA piece on that, no defined contribution portions for if it's paid out upon termination or retirement. So obviously there's a lot of different factors there that go into it. I do have some other just notes that I jotted down as I was kind of thinking about this, other considerations that you'd want to factor into it for such things as, hey, are they going to make it to retirement? Are they going to actually work, 5 more years? So just some of those things that we need to be thinking about or considering when we're coming up with these assumptions. Oops. Now, the next example that we have for you is a little bit more detailed. And really what I want to emphasize with both of these is the significance in the FIFO and LIFO liability. So what that liability amount is at the end of the year for one employee. So again, as we go through this, it's exactly the same, bank, the same amount of hours that are earned, same amount of hours that are used for each of these employees. Under the FIFO concept, as you can see at the very bottom, the liability is going to be about $51,000. Under LIFO, it's about $6,000. So you can see that dramatic difference between that liability just based on FIFO or LIFO concept. So we'll walk through this. I know we got plenty of time to kind of go through and do this. So under this example, The sick leave is paid out at $50 a day at retirement. So again, a significantly reduced rate at retirement at $50 a day. Employee A is more likely than not to retire in 10 years, and he earns a daily rate of $350 per day. So again, their sick bank at June 30th is 125 days. They're earning $20 or 20 days per year. They're using about 15 days per year. As I went through this estimate under the FIFO, I calculated that they would use their current balance in about 8.33 years at that average of 15 days per year. And then you can see at the very bottom there what amount is paid in salary. So the entire amount is paid in salary. So the 125 days at $350 a day comes out to $43,000. You would also have your FICA pieces and your defined contribution pieces there as well. So you can see that total liability of how that's calculated. Under the LIFO concept, again, they're going to be, earning and using some of those days each year. You can kind of quickly go through and see that even in year one, that they're going to continue to, have their balance grow each year. So you can see that that 125 days that they have today is still going to be available to them at retirement. And that is going to be paid out $50 a day. So you can quickly see that calculation there at the bottom of the page. So big impacts there on that liability. If you add in another piece to this liability or this example, and you say, well, what happens if, we cap our sick bank? So that's capped at, they can only get paid out at 100 days. So instead of getting paid out at the 125 days in our previous example, we're saying, okay, well, they're going to get capped at 100. So how does that impact my liability? One thing that we got to be thinking about is, as we have some of those caps, is, what does human nature tell us? A lot of people are going to go through and say, well, if I'm getting paid out only at 100 days, that means I'm probably going to use some of that as I get closer to retirement. I'm going to try to get it down as close as possible to that amount potentially that I'm capped at. So I don't want to leave anything on the table, right? So as you kind of walk through that scenario, some of those hours then are really going to be paid probably in salary, because they're going to be using that as they're employed. They're probably going to try to get down to that capped amount. If you went through and they did it perfectly, again, in this example, you can kind of see that increase in that liability. Again, previously it was 6,000-ish, it's up to $15,000 just based on that slight change in some of those assumptions. So again, there's a lot of factors that go into it. We do have an example Excel workbook that we've worked through. But again, every single union contract is different, which makes it really difficult to have one set example, maybe like we did for some of these other GASB statements. But again, we do have an example out there, and you just have to kind of modify it to what you have. So if it's, you have this cap, you'd have to factor that in those different components from there. All right, I'm going to turn it back over to Jeff to go over the next section.
Bill, just a quick question. Do you recommend doing the calculation on a employee basis or more on a group of employee basis and trying to make your assumptions based on that group, which could make the calculation a little quicker, I would imagine?
Yeah, I think from the examples that we've gone through, I think going through on a group of employees, as I was mentioning earlier, if you kind of look at it in some of those groups, if we look at it specifically for teachers, what does that, look like for those teachers? Again, maybe support staff or administrators into different buckets. I think on the one example we went through with the school district already, even this teacher area, we kind of looked at that group into different buckets as well, because we said, okay, these teachers that have worked for us for 15, 20 years, their chance of getting to retirement was significantly greater than the ones that have only been here for 0 to 10 years. So again, are they going to continue on and actually get to retirement? I think that was a big factor in those different populations. So I think we took each of those into different subsections, but I think it's definitely working through it in groups. I think it's going to be obviously significantly easier, reduced amount of time, easier to make some of those assumptions because you will have those trends in history that you can look at. And yeah, I think it would be obviously pretty difficult to kind of go through employee by employee.
So we do have a few questions, Jeff and Bill. So the first one, will slides be shared at the conclusion of this presentation? Yes, I believe we will be emailing those out. And the second question is, what happens with example 2 if our historical records show the employees cashing out the 50% sick bank and losing the other half? So the historical records would show they don't use it.
But go ahead, can you repeat that again?
Yeah, it says, what happens with example 2 if our historical records show the employees cashing out the 50% sick bank and losing the other half?
So if we kind of walk back to that example, so I would assume that we're talking under the LIFO concept. So they're, yeah, I think, I mean, obviously on some of these things, you know, each example or each contract is going to be, you know, significantly different, right? So, okay, if we say, okay, they're going to lose half of that balance and they're going to cash it out. So again, you know, I think you take that concept or that cap piece and you kind of look at that and say, okay, well, if they're not going to get paid out for it, are they actually going to use some of those balances up? So I think you would almost kind of think about it in this scenario of like, again, those employees are probably, if they're not going to get paid out, they're probably going to use up more of those hours, right? Before they get to that point in time. And again, if they're using it as part of their salary, and they're taking PTO off, then obviously that would be, you know, at that daily rate, of pay. So again, each of those, you know, just kind of have to factor in, each of those different scenarios or assumptions into your liability.
Yeah, I think to Bill's point on that is it can get complicated fast, and I think that's why we're trying to just make this emphasis of just make sure you are talking during prelim field work, just to make sure that you have a good feeling for what you need to be pulling to kind of come up with these estimates and really obtaining what this historical information even looks like. Because for a lot of us, until we know what that looks like, it's hard to even know what kind of situation we have in our hands right now. Going into the financial statement impact, just going through pretty quickly what some of those changes are going to be. So fortunately, I mean, most of our clients I think already know, but this is not a modified fund level financial statement issue. This is really just for an overall government-wide full accrual level, and that's why we're going to have a likely prior period restatement at only the full accrual level, and really no changes or impact on the fund level financial statements. Overall, I think we would anticipate an overall increase in the liability, probably an increase in some expenses on it as well as we start factoring a lot of these additional measurement and recognition items into the calculation. And as I had already stated, we are going to have a restatement of the beginning balances. This will be what we would call a change in accounting principle. So now that we're issuing a new GASB standard, we're going to take that into account. I did put a little snippet over here on the right side of things that if you are having a impact related to GASB 101, we will have a additional paragraph within the opinion that will identify that we did adopt a new governmental accounting standard during the current year. Potentially, if we're adding additional buckets that maybe haven't been pulled into the compensated absences calculation in the past, we may have some new items to include within your note 1 of the significant accounting policies. If they end up largely being the same, maybe there isn't a change there at all. Existing disclosure requirement. So when we go through here, I think the GASB, when they were going through the standard, feel like they were throwing us a bone a little bit on this disclosing a net change versus gross change. So technically, in the past, we should have showed both the additions and the I guess use of that compensated absence amount grossed up. Now we are allowed just to show one line for either additions or deletions. So that is something we're going to see. And we don't need to stipulate which funds are being used. It can all be kind of put into one bucket, which I think we've seen by and large in the past anyways. On the restatement, they do want a tabular format. So I do have an example on that in a couple of slides as well, but that'll just show what that restatement is going to look like within the financial statements. So here's what I was talking about on the additions and deletions. So when you highlight just that compensated absences portion of your long-term obligation footnote, I'm looking at that $3,000 number right there that's circled in red. So as you're looking at this, you can see we had an overall increase in our compensated absence balance in this example. So we don't need to show the gross up of the additions and deletions. We'll just have a one line item there, whether or not that balance increased or decreased. And for the change in accounting principle and the restatement of the beginning balance at the full accrual level, you can see that here. So because we do have a new accounting standard coming into play, we will have a footnote that identifies that we did adopt GASB 101. And then for the full accrual, you will see where we're going to be having that overall change in our net position restated to start the year. And that will be reflected here as well as within the basic financial statements as well, where we restate that beginning net position and show that within your financial statements as well. Going to turn it over to Kasey real quick to talk about one other new statement that came out came out already, but will be effective for our current year.
Thanks, Jeff. Before we jump fully out of 101, I want to address Tina's question in the chat. So the pay as salary is the assumption of what they will use after year end until we anticipate they will retire or leave. That would be correct, Tina. So you would use your salary rate at the rate of your use and then the payout rate at retirement. So you're correct in that chat. So I'm going to jump over to GASB 102. We did briefly want to touch base on this. We don't expect significant changes, but it is a new GASB and could affect you. So the effective date for GASB 102, which addresses certain risk disclosures, is effective for fiscal years beginning after June 15, 2024. So earliest years would be these June 30th, 2025, and going forward from there, this will be effective. Oops. So what this addresses is certain risk disclosures, and it requires a government to assess whether a concentration or constraint substantiates significant risk in order to disclose. So essentially what it does is if a government does determine that those criteria for the disclosure have been met, they should disclose it in the notes to the financial statements with sufficient detail to enable users of the financial statements to understand that risk and to act accordingly. So just a quick background example here, like let's say a school district with a year end of June 30th, 2025 has been notified shortly after year end that the largest property tax payer, which was about 30% of the district's collections, is expected to end. The analysis there would be the school district should include a disclosure in the financial statements, the concentration of the property tax revenue with ABC Corporation, and in the known instance of the financial statements. The thought there is that the decrease in the property tax revenue is likely to have a substantial impact and occur within 12 months of the financial statements being issued. Another example I have heard on this is with all the changes in federal funding. Let's say you're a government entity heavily relies on that. If you find out that government funding has been cut and would be significant to the financial statements within 12 months, and we know it when issuing, it may be worth a conversation with your auditor and a potential disclosure there.
Yeah, I think the key to this one, Kasey, is like, I think as people think about it, it's like kind of those precursors to like, kind of almost like a going concern of like, okay, if we're getting to that spot of we're having these significant impacts on our records, readers want to know about it, right? Of like, hey, there's this significant risk that's out there. Again, if there's cuts to the, something from U.S. Department of Ed and there's a cut to, a significant program at the school, obviously that's information for the reader. Obviously, you guys, as a district would make changes to your operations to accommodate those changes. But again, it's kind of letting that reader know, yay, there's been some significant changes. It's a significant risk to us. We need to make sure we disclose that. And then, again, maybe we don't have going concern considerations at that point in time, but if we don't do something about it, then there's other impacts down the road. So it's just letting those readers know of those potential impacts.
Perfect. And I didn't know if we'd have time to go over GASB 103 at all. Fortunately, this one we can still kind of kick down the road for another year. But it is something worth being aware of as we go into, I guess, the 25-26 fiscal year and what that impact might look like on the financial statement. So this is the first significant revision to the reporting model since GASB 34 came out. I mean, I started my CPA career after GASB 34, so that's all I've really known. And fortunately, although it wasn't always going to be the case, not a lot of real significant items are going to change. At one point, there really was some conversations about, are we going to continue to have a full accrual GASB wide financial statement? Does this look completely different than what it looks like today? But fortunately, we're not really going to be in a situation where things are going to change or look significantly different, just probably moving a few things around within the financial statements. So as mentioned, I mean, I know we just skipped the slide, but this is going to be for June 30, 2026 year ends. So as I mentioned, not a lot is really going to change. We're going to retain this financial current resource model measurement focus. That's going to be both your modified accrual. We're going to have the full accrual GASB-wide financial statements. No real change in the overall presentation. The biggest impacts we're going to see are really going to be around the MD&A, the management discussion analysis, kind of focusing that in on 5 categories, which we'll touch base on this very next slide. And then we're also going to be seeing a little bit of changes in how we present our budget to actual information, and really also comparing our initial budget to our final budget and explaining some of those overall issues. So don't need to belabor too much on this because we are really not worried about this until next year. But from a MD&A side of things, the biggest thing, other than going down between those 5 categories on the previous slide, is we really don't we don't want to be just restating information that might be redundant or repetitive to information that we've already seen within the financials or within the MD&A. And a lot of the explanations that maybe haven't been there before, we're going to want to explain the why, maybe something increased or decreased, and also identify from a budget standpoint, are we planning to use resources going into that next year, just to provide that reader a little more context on where the organization is going. On the budgetary comparison side of things, a lot of that's going to look the same. We're still going to have our variance between our final budget and our actual, but now they are also going to require a variance between our original budget and our final budget. And then if there are significant variances between any of those budgets that we just talked about, we're going to have RSI footnotes, which are already there for a lot of districts, but they explain what those variances really look like. So just adding a little more context to what's going on within the budget and a little more accountability to what you put out there in a budget, both original, amended, final, and then where you come up from an overall actual standpoint at the end of the year.
I would say that's one area that, throughout this year, as you make, again, your original budget, make any amendments to the budget, to have some sort of those details. If it's a significant change or significant variance between those two, is to have those details prepared and ready for those notes to the RSI. It's definitely something, again, I mean, we'll be starting the fiscal year in 2 months. So something as you kind of work through that fiscal year to say, all right, where would we start off with our original, and then any big significant changes to make sure we have good details of really what's happening there that we can add in.
Yep. I think that brings us to our last slide. There's nothing else that I really have. I'm glad all of you guys could be a part of this webinar today. Thank you, Bill. Thank you, Kasey, for your efforts going into this webinar presentation. And enjoy the rest of your day.
We
Thank
did
you
have
very
one
much.
more question if we got time.
Yeah.
From Melissa, says to calculate the liability can be take the average salary for the group and multiply by the total hours, or should we calculate each employee using the assumptions for the group?
I mean, I know, obviously history, I mean, what you've done previously is you probably have taken that by each individual employee. But there is obviously the examples that the GFOA and others have put out related to this. You could just take the average salary for the group. Again, you're taking a lot of those other assumptions in those factors. I would say if 10 of us on this call all went through the exact same liability, compensated absence, we'd all come up with 10 different answers. So again, I think having your assumptions there, things that can be audited. Again, we're looking at those details for how you came up with those calculations. If that's all available, yeah, that's obviously a acceptable method to look at that liability or that estimate.
Perfect. Thank you, Bill. And again, thank you, everybody. Feel free to reach out, post this webinar to any of us or directly to your partner or in charge on the engagement, and probably answer a lot of your more specific questions, but appreciate all of you being a part of the webinar today. Thanks.